All right, let's jump into another deep dive. And today we're tackling a question that I'm sure is on a lot of minds. Can leveraged ETFs like TQQQQ really work for long-term growth, or are they just ticking time bombs?
Yeah, that's the million-dollar question, isn't it? We've got a whole stack of research analyses and real-world trading examples to kind of sift through today. So let's just dive right in.
Okay, so let's start with the allure. TQQQ, which is designed to triple the daily returns of the NASDAQ 100, has delivered a staggering 2,100% return over the past 10 years. I mean, that dwarfs the returns of its unleveraged counterpart, QQQ. And that's according to ProShares data and the YouTube video, Should You Hold TQQQ Long Term?
Yeah, those numbers are certainly attention-grabbing, but you got to remember leverage is a double-edged sword. So while it can magnify gains, it also amplifies losses. And that's where this concept of volatility decay comes into play. This daily reset of leverage can actually erode returns over time,
Yeah.
especially in volatile
This
markets.
is not as simple as just tripling the long-term gains of the NASDAQ 100.
Not quite. The video, Leveraged ETFs, Not the Return Cheat Code You'd Expect, does a really good job of explaining this. Think of it this way. If the NASDAQ drops 5% one day, TQQQ would plummet 15%. Even if the NASDAQ bounces back with a 5.26% gain the next day, TQQQ wouldn't fully recover. There's actually an example of this in the Stack Exchange discussion.
Oh, well. That's kind of mind-betting. So even if the underlying index breaks even over time, the leveraged ETF can still be in the red.
Exactly. This effect, sometimes called negative return bias, can be a real drag on long-term performance. Even when the S&P 500 climbed back to its pre-pandemic highs in August 2020, the triple leveraged UPRO remains significantly lower.
So even if you're bullish on the long-term prospects of the market, holding a leveraged ETF through thick and thin might not be the best approach.
Yeah, that's a key takeaway here.
Yeah.
And this brings us to another question a lot of investors ponder. Is it better to invest in leverage ETFs only when the market is down? Can you time the market to your advantage?
Right, like buy low, sell high. But with leverage to supercharge the gains. I'm imagining, riding those market waves like a pro surfer.
Yeah, it's an enticing idea, but in reality, consistently timing market bottoms is incredibly difficult, even for seasoned professionals. And remember, leveraged ETFs amplify both gains and losses. So entering at the wrong time can magnify your losses significantly.
But wouldn't buying during a downturn, when the underlying asset is on sale, at least partially mitigate that risk?
To some extent, yes. But the key is knowing when that downturn has truly hit bottom. Mistiming your entry can still lead to significant losses, even with a lower purchase price.
So what's the verdict on market timing with leveraged ETFs? Is it a fool's errand or a skill worth mastering?
Well, it's more nuanced than a simple yes or no. While I wouldn't advocate for trying to perfectly time the market, there are strategies that can help manage the risks. The Brothers Automated Trading YouTube channel, for example, backtested a system that focused on limiting drawdowns while applying leverage to the NASDAQ over a 24-year period.
And get this. Their system generated a whopping 31% average annual return and an astounding 81,000% overall return.
Those numbers are impressive, but it's crucial to remember this was a swing trading strategy, not a buy and hold approach. It involved getting in and out of the market based on specific signals and a strict risk management protocol.
Right, and past performance, especially with leveraged ETFs, is not necessarily indicative of future results.
Absolutely. And remember, a 24-year backtest, while interesting, doesn't cover all possible market scenarios.
Okay, so we've talked about volatility decay, negative return bias, and the challenges of market timing. Let's shift gears a bit and focus on the returns themselves. How do leveraged ETFs actually stack up against traditional stock market benchmarks? Do they really deliver those 2 or 3x returns they promise?
Well, let's look at TQQQ again. The ProShares annual report shows that while it did deliver a significant 82% return in the past 12 months, it fell short of the expected threefold return compared to the NASDAQ 100.
So where is that missing return going? Are fees eating it up?
Fees definitely play a role. TQQQ has an expense ratio of almost 1%, which might seem small, but it compounds over time, chipping away at your gains. The data from TQQSummaryProspectus.pdf breaks this down.
So even if the underlying index performs exactly as expected, the leveraged ETF might not deliver the full amplified return due to fees and expenses.
That's right. And remember, we're dealing with daily leverage. This means even small daily losses are magnified, further impacting the overall return.
So it's not just about the potential for amplified gains. The potential for amplified losses is equally important to consider.
Exactly. When we talk about risk in finance, we often mean volatility. Using leverage multiplies both potential returns and risk.
Right, it's like a high-stakes game. where the rewards can be huge, but the consequences of a misstep can be equally dramatic.
Yeah, the stack exchange discussion highlights this well. Even a small loss on a leveraged ETF requires a proportionally larger gain just to get back to even.
So are you saying the leveraged ETFs are inherently riskier than traditional index funds, even if they track the same underlying asset?
Yes, that's a fair assessment. The daily reset of leverage creates a different risk profile that investors need to be aware of.
This is fascinating stuff, but I'm curious. If a leveraged ETF like TQQQ doesn't always deliver the exact multiple of the underlying index's return, why wouldn't someone just invest in a larger position of the unleveraged QQQ to achieve similar results?
That's a great question, and one that many investors grapple with. It really comes down to your individual risk tolerance investment goals and time horizon. Using leverage can potentially accelerate returns, but it also amplifies the risk of losses.
Okay, so we've covered a lot of ground already. The pros and cons of holding leveraged funds long term, the allure and pitfalls of market timing, and how returns actually compare to the traditional stock market benchmark. I feel like I'm starting to grasp the nuances of these powerful yet complex investment vehicles.
That's great to hear. It's all about building a solid foundation of understanding before making any investment decisions.
Now, I'm really curious to learn more about this swing trading strategy that the Brothers Automated Trading YouTube channel developed. Can we dive into that in a bit more detail?
Absolutely. Let's unpack the key elements of their approach and see what lessons we can glean from it.
Perfect. I'm all ears.
So the Brothers Automated Trading strategy you mentioned focuses on identifying periods when the Nasdaq is likely to experience a significant upward swing. They look for specific technical indicators and market conditions that suggest momentum is building.
So it sounds like they're trying to catch those waves we were talking about earlier, but with a more systematic approach.
Exactly. They use a combination of moving averages, momentum oscillators, and other technical tools to pinpoint potential entry points. And they're not just blindly buying when these signals flash. They also consider overall market sentiment and economic data to confirm their trades.
So it's a blend of technical analysis and a bit of fundamental analysis sprinkled in.
Precisely. They want to make sure they're riding the wave of a genuine upswing, not just a short-lived blip in the market.
Okay, that makes sense. But what about the risk management side? How do they protect themselves from those amplified losses that come with leverage?
That's where their system really shines. They have very strict rules for setting stop-loss orders. These orders automatically sell their TQQQ position if the price drops below a certain level, limiting their potential losses.
So they're not just hoping for the best at us. They have a plan in place to cut their losses if the trade goes against them.
Exactly. And they're not afraid to exit a trade if it's not working out, even if it means taking a small loss. They understand that preserving capital is crucial when dealing with leverage.
So their strategy isn't just about catching those big upswings, it's also about minimizing the damage when things don't go as planned.
Right. It's a balanced approach that recognizes both the potential rewards and the inherent risks of leveraged ETFs.
Yeah.
They're essentially trying to tilt the odds in their favor by combining careful entry selection with disciplined risk management.
And their back-tested results certainly suggest this strategy can be effective. But is it something the average investor could realistically implement?
It's definitely more involved than a simple buy and hold approach. It requires a good understanding of technical analysis, a willingness to monitor the market regularly, and the discipline to stick to a predetermined trading plan.
So it's not for the casual investor who just wants to set it and forget it.
Probably not. This strategy is more suited for investors who are comfortable with active trading and have the time and resources to dedicate to it.
Okay, so maybe not a strategy for everyone, but it's definitely fascinating to see how experienced traders are using leveraged ETFs to potentially enhance their returns.
Absolutely, and it highlights the point that leverage ETFs can be powerful tools when used strategically.
Now, speaking of strategies, we came across another interesting approach in our research. Vibhacha, a top performer in the U.S. Investing Championship, shared her method for trading TQQQ in a YouTube interview on the Trader Line channel. It sounds quite different from the Brothers Automated Trading System.
Yes. The pause approach is intriguing, while she also focuses on swing trading. Her method involves a unique blend of technical and fundamental analysis.
Okay, I'm really curious to hear more about this. What does she look for when deciding when to enter a TQQQ trade?
On the technical side, she looks for specific chart patterns and indicators that suggest a potential price move is brewing. She also pays close attention to the bulls versus bears sentiment indicator to gauge market psychology.
So she's trying to get a sense of both the technical and emotional drivers of the market.
Exactly, but she doesn't stop there. She also delves into the fundamentals of the companies that make up the Nasdaq 100. She looks for those with strong earnings growth, accelerating sales, and positive institutional buying.
So it's like she's got this multi-layered system for picking the best times to ride the TQQ wave, but always with a keen eye on the exit strategy.
That's a great way to put it. She's very disciplined about setting stop losses to protect her capital and taking profits when her targets are hit. She emphasizes the importance of not getting greedy and letting a winning trade turn into a loser.
And this approach has clearly been successful for her. She has achieved triple-digit returns in the U.S. Investing Championship, and she credits a significant portion of that success to her TQQQ swing trading.
Her story is a testament to the fact that there are ways to utilize leveraged ETFs effectively, even for those with a longer-term investment horizon. But it requires a shift in mindset, moving from a passive buy-and-hold strategy to a more active approach.
So it seems like the key takeaway here is that while leveraged ETFs can be risky, there are strategies that can help mitigate those risks and potentially unlock impressive returns.
That's a key insight, but it's important to remember that these strategies require a certain level of expertise and commitment. They're not for everyone.
Right before we jump into any conclusions, there's one more point I want to touch on from the Seeking Alpha article. The author highlights the importance of market timing even when considering a long-term investment, like a leveraged ETF. They point out that if you had invested in TQQQ at its peak in March 2000,
You would have experienced a significant drawdown in the following years, even though the NASDAQ has grown substantially over the long run. It really underscores how crucial it is to avoid chasing returns and jumping into a leveraged ETF just because it's been performing well.
so even if you believe in the long-term growth potential of the underlying asset, getting in at the wrong time, especially with a leveraged ETF, can severely impact your returns.
Precisely. Timing isn't everything, but it certainly plays a significant role, especially with leveraged products.
Okay, so we've explored the complexities of leveraged ETFs, analyzed different trading approaches, and emphasized the importance of risk management and timing.
Yeah.
I feel like we've covered a lot of ground in this deep dive as we wrap up. What's the key message you want our listeners to take away from this discussion?
Well, I think the most important takeaway is that leveraged ETFs are powerful tools, but they're not suitable for every investor or every investment strategy.
Yeah, that seems to be the recurring theme throughout our deep dive.
Mhm.
They're not magic bullets, and they definitely require a thoughtful approach.
Exactly. They have the potential to amplify returns, but they also magnify risk. It's essential to understand those risks and develop a strategy that aligns with your individual goals and risk tolerance.
So it's not just about understanding the mechanics of how these ETFs work, it's also about knowing yourself as an investor.
That's right. And it's about recognizing that there's no one-size-fits-all approach. What works for one investor might not work for another.
We've seen that firsthand by examining the different trading strategies employed by experienced investors, like the Brothers Automated Trading and Vipacha. Both have found success with leveraged ETFs, but their approaches are quite distinct.
Yeah. And their success stories highlight that leveraging ETFs effectively often requires a shift from a passive buy-and-hold mindset to a more active approach that involves careful timing, risk management, and a deep understanding of the market.
So for those listeners who are intrigued by the potential of leveraged ETFs, what would you recommend as the next step in their due diligence process?
Well, first and foremost, I'd encourage them to thoroughly research the specific leveraged ETF they're considering, understand the index, it tracks the level of leverage it applies, and its expense ratio.
Right, it's crucial to know exactly what you're investing in before taking the plunge.
Absolutely. And don't just rely on past performance data. Dig deeper into the ETF's prospectus, read independent analyses, and consider how it might perform under different market conditions.
So don't just chase returns. Understand the underlying drivers of those returns and whether they're sustainable.
Precisely. And finally, I'd recommend experimenting with paper trading or using a simulator to test out different strategies before committing real money. This can help you gain experience and confidence without putting your capital at risk.
That's a great tip. It allows investors to get a feel for how leveraged ETFs behave in real time without the emotional roller coaster of actual trading.
Exactly. Remember, knowledge is power, especially in the world of investing. The more you understand, the better equipped you'll be to make informed decisions.
Well said. I think we've provided our listeners with a solid foundation for understanding the complexities and opportunities of leveraged ETFs as we conclude this deep dive. Do you have any final thoughts you'd like to share?
I'd just reiterate that while leverage ETFs can be valuable tools, they're not for everyone. They require a certain level of expertise, a willingness to embrace risk, and a commitment to ongoing learning.
And as with any investment, thorough research, careful planning, and disciplined execution are key.
Absolutely. And remember, even if you decide that leveraged ETFs aren't right for your investment strategy, the knowledge you've gained through this deep dive will undoubtedly make you a more informed and discerning investor overall.
Couldn't agree more. Thanks for joining us on this fascinating exploration of leveraged ETFs. We hope you found it insightful and empowering. Until next time, happy investing, everyone.